Good morning, everybody. This is Retirement Income Options with Kirk Spano. It is the day before Green Bear Day and St. Patrick's Day. Going to visit some friends tomorrow who both have birthdays tomorrow. So they're both Irish guys with birthdays on St. Patrick's. So I'm curious to see how that birthday party goes. In any case, it is March 16th, 2021. And I'm going to kind of walk through how I do things with the screening and with determining where to look for options to sell. So the first thing I want to do is start with the stock screener over at TradingView. Now, I know that not everybody subscribes to this, but again, this is the number one thing that I think that you should have or something extremely similar if you are going to trade options of any kind. Why? Because you really need these overbought and oversold signals, and an easy way to follow along. This is like $25 a month. I've got links all over the place to sign up for it. I use the Pro Plus. I don't think you need the Pro Plus. I think you can go down one level probably, but the Pro Plus for sure is everything that you need. And it allows you to screen for oversold stocks or stocks that are close to oversold. So what I want to show you is how I built this list. You can build your screening list simply by importing something. So in this case, I took the VSL, which you can see has been getting updated. A little bit easier to read here. I copied all of these, then created a new list. So I'll show you. Go like this, copy them all, and then create a new file, then paste them in. So this is what it looks like at the end, is you end up with a new file with all the stock symbols. Then you go back over here to import list. You just import the list. And then it ends up looking like this, expanded VSL plus. So what do I have on my list? This is all the stocks on the very short lists, plus stocks that have been on the very short list that I just don't bother to take off because I like to keep track of them a little bit, and other stocks that I'm watching. So this is the VSL plus. And it allows me to screen all of these companies for relative strength. Oh, there's an intermediate step that you need to do. You need to tag all of these with a specific color. So in this case, I tag all my stocks as red so that when I screen, I can tell it I only want the red stocks. Those are the ones in my watch list. Otherwise, we can screen for all 6,500 stocks here in the universe. And you might have a reason to do that. So if I don't want to just look at my stocks, I uncheck this box here. I say, okay, what's interesting? What's oversold in the incredibly huge universe of stocks? And you can find all kinds of things here. You got to remember, a lot of times a stock is oversold because it deserves to be oversold. So in our whittled down universe, which is about 5% of all the stocks out there, you know, because I've screened these and read up on most of these to get a narrower universe, something that we can wrap our heads around. Too big of a universe. You know, think about all the stars in the sky. Could you ever count them? Could you ever keep track of them? Same thing with stocks. Minus a few zeros. Just keep track of the ones that you want to keep track of. Now, once you have your list built, you can start using different screens that they have built in. So if you want to take a look at valuation, you can say, okay, let's just rank these by price to earnings ratio. And you go through them and you say, oh, look, yeah, that's interesting. Pulte Group has a super low PE. Now, something that I would probably add here, and I haven't done it yet, is peg ratio. They might not have it. They don't. Price to free cash flow is always interesting, and so is price to book. Price to sales is also interesting. So you take a look at these and you say, okay, I build my screen the way I want it to be built. And say, well, I know that stocks that are low price to book usually are pretty interesting. So again, you go through here and say, okay, price to book. What's interesting? Well, look at that. Travel Centers of America. Interesting. U.S. Cellular Corp, which I've said for years is going to get bought. Some of the oil companies. Now, the oil companies, you have to start thinking to yourself, is that information right? Is their book value really what they say it is? And your unequivocal answer should be a smirk, a laugh, a chuckle, a chortle, and no. Their book values aren't as high as they say. Keep on going down. See, Wells Fargo is here, right about 1. When you get a financial institution about a 1-to-1 book value, price to book value, that's usually interesting. So these screens can be useful just for sorting things out. And honestly, I know some of you have Stock Rover and you like it, but I've been using it less and less and less for a couple of reasons. I can get all the sorting of all the data here. And I think it's a little easier to use. Now, I'm not using Stock Rover for any type of charting, fundamental or otherwise, because I have Sentio. If you want to chart out fundamental data, there's still a very good role for Stock Rover, and the correlation over there is interesting. But you're starting to see that in more and more places. You can do that at some brokerages, is take a look at correlations. So if you can get something for free, obviously you want to get it for free. Then you have to balance convenience factors. For me, I have so many learning curves that I go through that I've never fully learned everything in Stock Rover. I know that there's some amazing tools in there, and if you're using it, right, you're going to want to use that. I'm going to use Sentio because I'm paying thousands of dollars for this AI to merge data sets for me. So I'm going to learn that instead of learning Stock Rover. If you want something that's only $25 a month, instead of thousands of dollars, Stock Rover is the next best thing. As far as looking for trades, though, I just don't know how you can beat this, because if you come over here and you click oscillators, you say, okay, I'm looking at the 1 week charts, right? Now you can do any length of chart, monthly, weekly, daily. Daily, if you're doing swing trades or even 4 hours and 1 hours, you can use different time frames. And what do those time frames mean for those of you who are a little less acquainted? That is how long the period is when the measurement is taken. So a daily chart means that the information is snapped in at the end of the day. If it's a 4-hour chart, they snap it on the trailing 4 hours. If it's a weekly chart, it's the closing value every Friday. That's what they base everything on. So this is updated every minute. This is updated every 5 minutes, every 15 minutes, every hour, every 4 hours, every day, every week, every month. So I'm going to use the weekly chart because I know that this is the one that gives the best signals in the under 1 year time frame. So if you are looking for opportunities that are going to last for months, then this is the one you want to use. If you're looking for opportunities that will last for years, you can actually use the monthly charts. But the problem is that you don't really get to the extremes on the monthly charts, but a few times per decade. So if you're a long-term buy and hold investor, you can use the monthly chart. And like in last April, you would have just bought a whole bunch of long-term holdings with the idea that, okay, when the monthly chart gets close to overvalued, then I'll start trimming. And so I actually want to give you an example of that because I think it's important. We're doing a little bit of technical work today because I want you to embrace this. So we take a look at the S&P 500. Let's go back 5 years. Shrink this up to make it easy to look at. There you go. So this is a weekly chart, and you can see that the stock market is getting to be overbought on the weekly. Interesting here, it was already overbought on the money flow index, which is a volume weighted relative strength index. And this is heading down pretty hard. Why is that? It's because there isn't as much volume today as there was a few weeks ago and a few months ago to push the strength of, the market up, to give the market strength. What have we been talking about? We've been talking about how liquidity is slowly coming out of the market. This is a leading indicator to the relative strength. So relative strength will generally follow money flow. So with the money flow dropping here, that means volumes are going down. That means that we'd probably expect this to come down in the not too distant future, unless volume goes back up and money flow heads back up. So there's a push-pull from money flow index to relative strength index. And relative strength index is the one that everybody cheats with, but I'll tell you, in my career, the relationship between the two, I think, has always been more important. Of course, you have shaken money flow, which is similar to money flow index in that it incorporates volume. It uses different prices. When it's chopping along in the middle here, it usually just means a choppy market. When it's down here, it means a choppy market or a negative market. When it's up here, it's positive market generally. And as it comes down, though, you add more and more chop to the market. So it was way up here, and you got a spike. You can see that. See how the market spiked? So here's shaken money flow, pretty high. And look, that's right where it spiked. And then shaken money flow came up again here, and you have the rally. Then it started chopping. The market started chopping. Turns up a little bit, market turns up. Now, if we switch this to the week, or well, let's take one more time at the weekly. See how the weekly came down and got oversold right here? Right here. Signaled a buy that I largely missed because I was looking at the monthly and I didn't read it as well as I probably should have. I thought right here, stretch that out a little bit, make it easier to read. I thought, see how the monthly doesn't quite get oversold? I thought the monthly would go oversold, and that's why I didn't jump in as much as I should have. Once it started going up on all the Fed stimulus, you realized at some point, well, you have to at least start picking off some things here and there. And now it's relatively overbought on the monthly chart again. This is a huge signal of danger in the stock market. What does the money flow index say? Money flow is still inching its way up. As soon as this changes directions, the market's going to get pulled down. So we already have seen this start to go down in the weekly, which has caused this to turn over a little bit. If it keeps going the way that it's been going, with the liquidity draining out of the market, then this will come down. This will come down, and this will come down. How often does the monthly chart get oversold? Here, then not again for a long time. This is the era of Federal Reserve intervention. If you go further back, and if this chart went back to the 60s, you'd see that this actually would happen 1 to 3 times a decade. So here it is, finally gets oversold at the end of the tech crash. Then again here, 8 years, 9 years later. And we could change the symbol to index. There you go. Now we can go way back in time, and it's real hard to read. But if we take a look at relative strength index, there you go. Here, here, here. Never quite made it in 2020, and you would have thought that it would. Gets close here, gets super close there, super close, and you're going way back, way back. So what have we learned really since the 80s is that the United States has been intervening in markets to create inflation, is what they say ostensibly, but where they're really creating the inflation is in the asset markets. At some point, there's got to be a hiccup, just like 2018, there was a couple hiccups. This year, or in 2020, there was a major hiccup, but they sprayed money on it. The reality is that we have, I think, narrowly avoided 2 depressions in the last 12 years. And it has to do with Fed intervention and really just no conscience when it comes to deficit spending. And again, I would say maybe Dick Cheney is right. Maybe deficits don't matter for the United States. I think there's a pretty good argument that really deficits don't matter terribly much for the United States, so long as everybody else is running deficits too. If we were the only one, it would be different. But we're the strongest economy out there among the big economies by far. It's not really terribly close, actually. And, you know, we're the cleanest dirty shirt. So when you take a look at all this information, you just start asking yourself, okay, how do I play in this market? And the answer is use your technical signals to give you an idea of where the money is going and whether or not there is more risk or less risk in the trade that you're putting on. And that's where this comes in very, very handy, is you say, okay, of the 269 stocks that we're following, including the ADRs and the SPACs and everything else, because I think I've got everything in here now, let's rank this by relative strength index. You say, okay, where do I like some of these? Well, we just sold the cash secured put on this one 2 weeks ago. Look at the 3-month chart, especially the 1-month chart. Give it a nice stretch. And since we sold that cash secured put, this thing's been drifting up, which means that that put on OnTrack is probably just going to expire. That's why these signals are so good. I don't know if I love Quidel anymore. Quidel, I'm not really sure how they say it. But if you take a look at this one, pop up the 1-month chart just so it's easy to look at. So you see I haven't charted this in a while. Still got all my old colors in there. You know, it's starting to drift up because it got so oversold. You see here your volume indicators. This is lots of buying and selling. As these lines come out, that's lots of interest. This probably can drift up to here before it runs into super heavy resistance, 170-ish. Right? Will it come? Will it get all the way back up to here? Right? You have to remember, why did this stock rally? Does anybody know much about this stock? Testing. So these guys, huge rally on the testing. And now the company has to start putting up numbers because the hype rally is over. Now it's choppy and it's coming down. Now, is there another leg down on this? I don't know. You know, it definitely could hit in here and come back down and get down into this area. but I don't know what their profitability is now. My expectation is that on COVID-19 testing and similar tests that we're going to have to start taking in the future for variants of COVID and new super flus that are coming out, I would imagine this company is so embedded now into the system that they probably are worth more than this area. And this appears to be a pretty strong support area, although it has been drifting down. So there might be one more leg down. And that's why I say the technical indicators are important, but you have to know the story of the company. So even though this one is super oversold, you need to flip back to the fundamentals and say, okay, are these guys basically at their bottom fundamentally? And the technicals and the fundamentals will now align to drive it back up. I think that's what's happening with OnTrack. I think the technicals and the fundamentals are aligning to see the stock gradually rebound. And we've talked about this company before. So the numbers here aren't automatic. You don't say, oh, look, it's a 37. I got to sell the put. You don't know, because what if it goes to 29? But this is just letting you know, hey, take a look at that stock, take a look at that company. And if at this price you like that company, this is about the time to sell the put. And this is what we did just recently. And we're going to make those giant premiums on OnTrack. Now, let's take a look at Alibaba. Well, look, relative strength index is oversold. It's in the 30s. Do I want to sell a put on Alibaba? What one word that makes you smile, what one word could make you pause and have caution before selling a put? That's right, commie. People putting up commie. That's right. Because the commies, who are different than the Chinese, I love the Chinese. I do. I had a great professor from China. I've got Chinese friends, you know, I mean, and I know that sounds like the, oh, my friend thing, but the reality is that we have to separate when we look at the world, who the jerks are and who the jerks aren't. And by and large, most people aren't jerks. How do we know that? Because if most people were jerks, we'd be killing each other all the time. We interact so much that if most of us were jerks, we wouldn't survive. It would be the apocalypse every day. But there are pockets of jerks, and the commies are among them. So the people in the Communist Party are either, you know, megalomaniacs or ideologues who just don't know how dumb they are, or they really just don't have any ethics or morals because it's all about them. But the rest of the population, they're like, hey, let me live my life. In any case, so you take a look here and you say, okay, yeah, I think we can get rid of these. And you say, what do I think of Alibaba? Well, have you seen the news lately? What just happened in China? They're taking over the press. So the South China Morning Post, I think it's called, I used to read pretty often because it was owned by Alibaba. And I trusted Jack Ma a whole lot more than I do the commies. Well, the commies are now saying, hey, spin that off so that we can control the press. So now some of the press in China that had been semi-independent, you know, through Hong Kong, is now getting controlled by the commies. So don't ever forget that there are risks here in China that you just don't want to have to deal with. So would I ever buy Alibaba individually? No. And in fact, I like I said, I'm going to take all the Chinese stocks off of our list. But I'll leave it here just so we can glance at it from time to time. But I'm going to take it off the VSL spreadsheet. In fact, here, would you like to see the ceremony? Alibaba. Where is Alibaba? Is it consumer? Did I already take it off? I didn't have a formal ceremony. Oh, there it is. I went right by it. All right. There you go. It's gone. It's 10 cents on here. Well, there you go. What's your favorite video game? Make the sound of your favorite video game. Here you go. 1, 2, 3. What? Oh, it fought back. Boom. There we go. Gone. So all the Chinese stocks are coming off because they're just untrustworthy. They really are. There's no point in investing in these individually. If they're in a basket that you own, like EMQQ, you know, you can do that. So let's take a look at EMQQ because we know that we'd like to own it someday. And talk about relative strength index overdone. That looks like something bad's about to happen, doesn't it? Take a look at the money flow index. Doesn't look encouraging, doesn't it? And I don't know if Bonnie's on. But this sure looks like it's gotten out of line. I mean, could it stretch up a little higher? Sure. Eventually it'll come down like this. So as soon as this starts to turn over, Katie barred the door. It's going to be in trouble. You know, I did allow for a potential rally. We'll see. My guess is that it gets way down here. So we'll probably want to sell a put when this gets down closer to the bottom of the pink range, which probably means the price will be in here somewhere. And then we can own a basket of emerging markets companies where 20 or 30% of it will be China, but we won't have exposure to just one Chinese company getting blown up. And speaking of one Chinese company getting blown up, go here to a 3-month chart. Y'all saw what happened to 10 cents. And that's a pretty big gap down. Again, because the government is screwing with them. So the government helped build these companies up. So that should be a warning right there, right? If a government helps build a company up, that means when a company loses the support of the government, whether just by less incentives or outright negative actions, the second step in our process, right? We look at the big secular trends and we look at central bank and government policy. This is very difficult to invest in Chinese companies because of what the commies can do to them. All right, so back to your screener. I think you should, this is the, like I said, this is the one tool that I almost insist on you having, because now you can rate all these and you can make other lists too. So I haven't completely got this one in yet, but if we switch our screen to Etf Favorites and we take a look at the blue, which is all my ETFs, 187 ETFs I'm tracking. Now we can also look at what's oversold on the weekly. And I actually was going to talk about these bonds. You know, I hate bonds. I do. I can't stand them. But now that the interest rate has risen and probably goes up just a little bit more here in the short term, you have to start asking yourself the question, at what point is there a hiccup that requires lower interest rates again, or that the market responds to with lower interest rates on the long end again? So these are long end, right? TLT is 20 years, IEF is 7 to 10 years. And we talk about the 10-year treasury all the time, but the 20 is really, with the longer tail there, the one where you can make a little bit more money. So I want to open this up and I want to show you something. I want to get rid of all this charting. because it's old and ugly and hard to read. Just want to show you the box that I identified here. Anything above this box is unsustainable because that means that interest rates are near the zero bound and the Fed wants to bring it back. Anything below this box, probably you have to start saying, is it a buy? Because now we will have to sustain very significant growth in order for the long end of the curve to stay up higher. As this comes down, especially into here, that means interest rates are probably up towards 2% on the 10-year Treasury. You need to ask yourself a question is, do I want to start selling puts on this? Because this level in here, it's going to be awfully hard to get below. So let's create a buy zone that makes some sense. And again, why would we ever buy bonds, given that I hate bonds? Anybody want to restate or frame that? The reason we might want to buy bonds, if the long-term interest rate gets high enough, that's implying big growth in the economy for an extended period of time. Do we expect huge growth in the economy for an extended period of time? No. Why don't we? Slow growth forever. Come back to the big secular trend. What is it? It's demographics. And all the accumulated debt on top of that, and the disinflationary impact of technology. Even if we do rebuild the world, that's only going to offset all the deflationary pressures. So if the 20-year Treasury drops down into here, I guess go here. I really can't see it going below here. Why? This is the first time we had taper tantrums, right? Then again. Look how this stretches out. In our lifetime, we may not return to normal on interest rates, being 5% on the 20-year Treasury. 4 something on the 10-year. Might not ever happen. Could, maybe when we're all old. But this is how you use these charts, and you juxtapose it with your fundamental view. So this gets down in here. It's a signal for you to reevaluate your fundamentals and say, okay, at this point, are we rebuilding the world? Or are we, getting a watered down plan in Congress? And what are the odds that the Democrats and Republicans agree on something? It's not going to happen. So there's going to have to be reconciliation, which means that Joe Manchin writes the next bill again, just like he wrote this one, which is why the liberals are angry. It's because they're getting a moderate plan. In my opinion, it was a pretty good plan. We'll see how the infrastructure works and all the rebuilding. President Biden's talking about $4 billion with corresponding tax increases on the top 1%. We'll see how that goes down. But the odds of all of a sudden growth being perpetually 3-ish% again, we're going to get the big bounce this year, 5, 6, 7, 8%, whatever it's going to be. But that's not going to be every year. By next year, we're back to a 2 handle. And I think if we're lucky, we hold the 2 handle, 2.1, 2.4, 2.6, maybe a 3 sprinkled in for GDP growth. And that's with spending money, borrowing money to rebuild the world. And borrowing money typically raises interest rates. And I'm focusing on this because at some point, what does the Fed have to do probably? probably has to do a whole bunch more QE. Then this will go back this way as interest rates head back down. So think about the real estate that you've bought in your life. And I want to cover this as well. Think about real estate. I just bought wisconsinshore.com, by the way, because we're going to get into selling lakefront real estate. And we, meaning my girlfriend, I think that the tightness in the real estate market is about to loosen up. Why? There's a lot of commercial real estate that has to be repurposed. How's it going to be repurposed? It's going to go multi-use. And certain buildings might even have to come down because the plumbing won't support conversion of half of an office building to residential in many cases. So you'll see a building boom there too. A lot of things are going to go down this decade because work from home is here forever. All right, so what do we want to sell puts on this week? I don't even know what I changed, but sure, we'll take it. Oh, well, I'll fix it later. I see. Didn't change my tag. Remember to change your tag. There you go, the red ones. I want to take a look at Sirius. It's coming out of being oversold. And I'm going to use this as an example. There we go. That's what I wanted. Double top. It was about to double top when the coronavirus hit. And now it's coming out of this. This is a stock that I focus on in the Stocks of the Week article that I have to edit as soon as we get off of this call. The chart that we drew looks right. Talked about this yesterday. You probably have a target of about 12 bucks a share on Sirius. So you can sell puts on this real easy. I think you should still own a couple shares because look, here. I drew this line a long time ago. Looks like it's working. The stock's up 13 cents today. Once it gets through this 667, 670 mark, it's going to jump into the sevens pretty quick. And then once it has some momentum, it can start skipping all the way through here. I don't know how many of you use Fidelity, but somebody asked me about this chart. They were like, what is BE in SP? Stock price, break even. Somebody else asked about, well, I sold a put and a covered call on MP Materials, and I don't want MP Materials to get called away. I'd rather roll out the call and collect more money. The problem with that is that usually the math doesn't work because, and somebody mentioned this in the chat, how time value of money works. Rolling out option positions, even covered calls, isn't generally a great idea. Just usually isn't. You're usually better off to use the volatility to your advantage to just keep doing this cycle. And remember, you shouldn't write a covered call against all of your position, right? Because then if it's a winner, you're losing out on the entire winning. So we've talked about that before. Don't write a covered call on your whole position. You know, and a way to avoid doing that is when you buy your shares of a stock, instead of buying 300 shares of MP or whatever, buy 299. And that way the system blocks you from writing that third covered call. I like that a lot. So if you want to buy 500 shares of XYZ widget company, buy 499. Then keep in a third of your position uncovered, maybe a quarter of your position uncovered. Pretty good idea. Then just use this cycle. So I actually retitled the this to using retirement income options so that it's easier to find in the getting started articles, which I've been updating. So when you're pulling companies off of here, you can go over here to Fidelity, and I think every brokerage has this. I know TD does. Okay, what's my break even? How do I illustrate my options? So if you go to Fidelity, you say, okay, serious, and I want to sell the $7 put. Well, the stock's only $6.38, Kirk. Yeah, so what? If you don't own this stock, you want to own it. So sell the in-the-money put. You get about 88 cents for it, which means your break even is what? 7 for the strike price minus the 88 cents you get. So $6.12 is your break even. And on this chart, it shows you where you start to make money. Right there. I think I'm cruising at 638. And then you start, and then you don't make any more money. Right? That's it. This is the max. If you already own Sirius, then I think maybe you sell the $6 put. You'll get a lower premium. Go here, Siri. Oh, I'm logged out now. All right, well, whatever. Have any of you, you've all seen this before, right? If you're trading options, you've seen this at your brokerage. Anybody at Fidelity, right? So this is a good way to figure things out. And this is actually a good illustration of why rolling positions doesn't usually work. Because between the time value and the new technicals, right, this equation is different when you do it. So on MP materials, somebody asked about, look how overbought it is. Why would you want to sell? Why would you want to roll this at this point? You're just not going to get the oomph anymore. It's volatile though. So here, let's roll this. Let's take a look. And this might be a case where it actually makes sense, but I don't think so. Look how volatile this is. I mean, you are regularly seeing this stock move, what, $2, $3, $4 a day? Look how right we were when we charted this, and I said it's going to break out, and then it did, like within days. I think I charted this here or here, one of those days. And then it broke out. So now you look at it and say, okay, is this stock ready to scream higher? This clutter here, I think normally would indicate it's going to break higher because there's a big open gap in here, right? A lot of air. It's not going to take much to push it up. Your better bet here, rather than selling a new covered call, is let your stock get called away. And if you really want to own this, sell cash secured puts at multiple levels. Sell a 35, sell a 45, sell a 55. Why would you sell puts at these increments at 55 and 45 and 35? Because if it screams up, you collect all the premium, including this premium, which will be huge, right? Somebody quick tell me, what is the April $55 put getting you right now? 12 bucks, 13 bucks. I mean, I'm not saying that you can't roll calls, but usually there's a better answer. Usually it just has to do with the pricing of options. And this being a volatile stock, you can sell puts on a down day as it comes up, and you can do calendar trades. Don't write all your options for April. Maybe write the shorter term option, April at 55, May at 45, June at 35. Figure out what is good for your risk tolerance, what fits in with your asset allocation. And down days, you know, today's a flat day for MP. It's actually, you almost want to take a look at a 4-hour chart. Say, what is this doing? Is it consolidating like it did in here again? Yeah, that's pretty similar, isn't it? Yeah, maybe not. So that's higher. Yeah, I don't think this is real definitive at this point. I can't see a way to make pretty lines that make a lot of sense. But I will say, I think this is probably your downside, 35-ish. See how it came down here and then said, no, don't want to go down there. Started to come down, said, no, don't want to go down there. So, okay, I think it was Kathy. I would probably sell a spread of puts if I were you. Go ahead and wait till Friday, let your stuff expire if you don't have the cash. But I would say a 55, a 45, and a 35, April, May, and June. Presuming those are out there. All right, I'm going to go through, insert the file, and I'm going to go through these again this afternoon, put them out there for you. I don't know that there's a whole lot. I would focus on Sirius. I really think that Sirius is something that you should be selling puts on because A, there's like almost no risk with this company, and there's a potential huge upside. So this is one of those rare situations where you have an asymmetric formula. Low downside, big upside potential, right? Liberty Sirius Media is going to absorb them. There's probably another strategic transaction coming. They've talked about merging Sirius and Live Nation. And why would you do that? Because then you can put all those concerts on Sirius. And you probably get a TV partner. What entities are out there that might become good TV partners? So, you know, there's some pretty interesting stuff here. But concerts on Sirius Satellite, if you've not listened to them, they're pretty cool. So I think the Live Nation Sirius merger is quite possible. Maybe it all just exists in the Liberty tracking stock that we like. LSXMK. And who's buying all kinds of this? Yeah, that guy from Omaha. And honestly, I don't know that this matters anymore because the company really got changed on the pandemic. What John Malone did is he rejiggered the holdings in here so that he could bail out Formula One. So I would think that pretty good chance this busts out into the 60s relatively soon. I think you need to start selling puts on this again. You know, we've talked about this. There's not a very robust market. This problem. But again, I would do a spread. If you don't own this yet, somebody's always buying it in here. You know, Buffett bought a bunch of it here, and here, and then somebody supported it in there. I haven't checked the filings to know if it was Buffett, but they're really not much risk below 40. So I would be selling a spread of these puts again, depending on what you own, what you can fit into your asset allocation. But in a world where getting 50% returns on a stock is going to get harder, this is one of those things where there's just not a lot of downside and there's a ton of upside. All right. Any questions about any particular security? Take a look at the screener. You see there's an awful lot of stocks that are getting close to overbought. Awful lot of stocks that are overbought or getting close to overbought. I mean, look at all those 70s and 60s. And we just looked at the S&P 500 and it was almost overbought on the weekly chart and the monthly chart. Valuations are out of whack. The market's going to start separating winners from losers more and more as liquidity slowly goes down. And this idea that liquidity is going to surge in the short term is wrong, because a lot of that $1,400 is not going into the stock market. And what does? I mean, so what if a couple $100 million going to the stock market. Big deal. All right. I had a reason for liking BST versus BSTZ. I don't remember what it was. There's a difference in the holdings. Take a look at the holdings. I don't remember what the difference was, but BST is more like QQQ than BSTZ. So if you take a look at this, all right. So these are in the middle. So this will be depending on what you want to do with the direction. Take a look at the weekly chart. QQQ. Yeah, I don't know that it matters much. Again, I don't remember what the difference was in the holdings of BST and BSTZ. This is a clear topping pattern. I think it's going to come down into here for sure. So I'm not ready to sell puts on this. But I am pretty much going away from using QQQ because these are so good. You know, and I have accounts that I manage where having that 4% dividend yield is pretty attractive, right? Because they're doing the call overlay. And this will actually be a little bit less risk than QQQ, theoretically. Somebody asked about if you sell a put on something that's in the money, does it get exercised immediately? No. Think about it from the side of the person who bought the put. When do they make money? They make money after it goes above 7. So why would they buy it? You know, why would they buy it? They bought the option specifically to speculate on the stock going above 7. All right, let's call it a day. It was a long session, but I wanted to go through all of this stuff with you so you can use it more effectively. And I will get this article out shortly. Have a good day. And I will get this article out shortly. Have a good day.